Okay, this mock exercise is the second part of foreign currency transaction, and we're going to take a look at the question called Hamilton Importing Corporation. So let's take a look at the question. So this question, Hamilton, HIC, imports goods from countries around the world and for sale in Canada. On December 1st, HIC purchased 10,000 watch for $600,000 at a spot rate of 0.741. So let's take a look at that. So I'm going to write the date down, December 1st, year 3, transaction date. The spot rate was 0.741. I just like to write it down just because I want to make sure that I look at all the different exchange rates on a particular date of time. The invoice called for payment to be made on April 1st. So April 1st is the date of payment. Put the payment date. And it says on December 3rd, year 3, they entered into a forward contract. So December 3rd, year 3 is the forward contract. And the forward contract, the forward rate is 0.781. Okay, hedge accounting is not applied. Fiscal year end, HIC, December 31st is the year end. And this is similar to the question that we just did, the Manitoba export. December 31st, the data spot rate was 0.757, and the 90-day forward contract rate is 0.786. And on the date, the supplier, the spot rate is 0.802, and presumably the forward contract is the same on that date as well. Okay? Now, that's what this is. And now we're going to look at the journal entries again on the date of purchase and the forward contract. We're going to take a look at what are the year-end adjustments to these forward contract and payable. And then we're going to take a look at what happens in the date of payment. Then again, we're asked to do a partial balance sheet as well. So let's take a look. Now we already know that the entire cost of the contract, so I'm going to write that down. So the cost of the forward contract is going to be the difference between these two, 0.781 minus 0.741, which is 0.040 times 600,000. Okay, so now we're going to double check to make sure whether this is the right number for the overall FX gain or loss. Okay, so in this case it's going to be probably a loss, but let's take a look. All right, let's look at the journal entries. The first one is the date of purchase. Again, we're going to December 31st, year 3. We're going to debit inventory for 600,000, okay, DM times 0.741. That gives us 444,600, and we're going to credit accounts payable for the same amount. Now, on December 3rd, we're going to record the forward contract. So let me write the word purchase. So this would be PUR. This is FX. Okay. So the forward contract, so think about this. we have an obligation in foreign in foreign currency unit. So we need to be able to deliver foreign currency unit 600,000 on April, I believe, April 1st. So I want to be able to execute a forward contract with normally a bank who's willing to accept the risk. And this time we're going to debit a due from bank. So I want the bank to deliver a foreign currency unit, and it will cost me the forward rate, which is times 600,000 DM times 0.781. That's the value of the forward contract, 468,600. We're going to credit payable to bank in Canadian dollars. So this one does not change. This is how much you're going to pay the bank, and the bank will give you 600,000 DM so that you can deliver it to your supplier on April 1st. That's essentially what you're trying to do. So this is December 3rd. Okay. This is December 1st. Okay. Now we're at year end. So at year end, December 31st, we need to record any FX gain or loss on monetary items. So the monetary item here is the accounts payable. And you'll see that the exchange rate went from 0.741 to 0.757. That means we have an exchange loss. That means I'm going to owe more in Canadian equivalent. The fact that the exchange rate went up means I need to actually pay more. So I'm going to debit FX loss, and that is DM 600K times the difference between 0.757, which is the year-end rate, spot rate, minus 0.741. And that gives us $9,600. And I'm going to credit accounts payable DM. Okay? That's $9,600. So this is the purchase. Okay. Now, we're going to also translate the due from bank. And in this case, the forward rate went from 0.781 to 0.786. Now, that means that receivable has gone up. The receivable from bank, the value of that receivable from bank has gone up. So we need to debit due from bank DM currency, and that would be DM 600K times the difference of 0.786 minus 0.781. And that difference is 5 cents times 6. 0.005 times 600,000 is $3,000. And we're going to credit FX gain. And this is the forward contract, FC. Okay? Now, so that's at year end. So let me just highlight that. And this is the date of purchase. Let me put the word number 2 in here. Now, at settlement date, what are we going to do? Oops. At settlement date, we are going to record, again, we need to record the FX, so the liability, again, went from 0.757 to now 0.802. It went up. So now I have to increase my obligation and create a further loss. So debit FX loss, and that is DM 600K times the difference between 0.802 minus 0.757. He issued 27,000. And we're going to credit accounts payable in foreign currency unit. And what happens to the forward contract? The forward contract, the value is also increased. So now we've got so this is the purchase, right? And now the forward contract entry we need to record here is we're going to debit due from bank in DM, and that one went up, right? The receivable went up. Why? Because the forward rate is now 802. Okay, so now we're going to actually pay payable to the bank for cash. Now, how much did we set that up, right? We set up, I'm going to now determine what my obligation is, right? So I need to debit my accounts payable, credit cash, and that is DM 600K times 802, and that's 481,200. So I need to pay them, right? So how did I get 481,200? Take a look. You've got 444,600. Then we increase that liability, so it's 444,600. So you can either do it this way, or you take the 444,600, then you add 9,600 and another 27,000 for further loss. So you get the 444,600 plus 9,600 plus 27,000. You get 481,200. Now, the payable to bank, so we're going to debit payable to bank, credit cash for $468,600. And remember, we set up right? So we know we have to deliver it, but now the bank's going to give us cash to pay the payable. So we already record the payable, and now we're going to debit cash and credit due from bank. That's 481,200. Again, how did I get that? Well, there's two ways to calculate that. It would be 600K times 0.802. You can certainly do it that way. Or you take a look at the forward contract, right? So you started with 468,600. Then we had we actually increased that by 3,000 because we recorded a gain. So we made, right, at December 31st. And then we also had another gain of 9,600. So if I add those three, I get 481,200. So there are basically three different sets of entry. So maybe you need to look at it from this way. First is we need, so remember, we we know that we have to pay the 468. So that was the forward contract that we set. And we agreed that the value of the bank delivering us 600,000 foreign currency unit is worth 468. So we go and give the bank 468 to deliver foreign currency unit. Then the second step is we're going to take that money, and then what we're going to do is we're going to, the bank, apologize, we have to give 468 to get the foreign currency unit. The foreign currency unit comes in, we need to debit it at the spot rate at the date that we receive the funds, and then we go out and deliver it to our payable. Okay? Now, so let's take a look at the balance sheet. So that's part of the second question. So what does the balance sheet look like for Hamilton? So Hamilton Importing Corporation, partial balance sheet as at December 31st, year 3. Under the asset, what do we have? Well, we have, so at this point, this is a net amount, but yet at December 31st, we end up having an asset of forward contract of 3,000. Now, how did I get that number? It's due from bank 471,600, which is the difference between 468,600 plus the 3,000, right? Less forward contract. And that forward contract is 468,600. That gives me 3,000. Again, we're only reporting the net. Only report on balance sheet the net forward contract exposure. What about the liabilities? Well, we have accounts payable, don't we? And that accounts payable is 444,600 plus 9,600. And that gives me 454,200. Okay? Now, what about the income statement? For year 3, the FX gain or loss will be, in this case, we will have a loss of 9,600 less the 3,000. And for year 4, we're going to have a loss of 27,000 offset by the $9,600 gain, and that would be 27,000 less 9,600, 17,400 loss. The overall is 24,000 loss, which is equal to what we said originally, wasn't it? We said that it was going to be the difference between the forward rate and the spot rate. And that's how we determined the loss.